Geopolitical risks are elevated, market leadership is shifting, and investors are asking new questions. Is a broader market really a better one? And what matters most as volatility rises? We're going to take a look beyond the headlines to explore market breadth, earnings quality, and how investors should be thinking about positioning portfolios from here. All that and more coming up on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. I'd love to welcome back to the studio my guest, Julia Hermann, global market strategist from New York Life Investments. Thanks for coming back, by the way. It's good to see you.
Thank you so much for having me back.
Yeah, last time you were here, and we weren't even in this studio, we were in our previous one, we were talking specifically about AI and energy, and boy, that is a conversation that has happened many, many times, and I'm sure you've had it as well. But, we're now sitting here at a very different time. We've got the Iran conflict as we sit here in various stages of ceasefire, and there's still conflict, there's still, resolutions are not quite yet arrived at. There's so much uncertainty in the markets, and there's this kind of sentiment of broadening your portfolio, looking further than just down the straight and narrow path of large caps and tech, which we talked about really for the last 2 years. So what should investors be focused on right now, Julia, that goes beyond these day-to-day headlines that can be sort of a whipsaw, a lot of shock and awe, sometimes it's calm. We just don't know what to expect from a day-to-day.
Right, exactly. I think we need to go back to the start of the year, which feels very long ago. But Wall Street entered this year with consensus optimism. And now the Iran conflict is one of several distinct disruptions that is greeting what was originally a very constructive scenario, and one that we have shared as a team and one that we actually stick to. In addition to Iran, markets are coping with a maturing credit cycle. They're also coping with sentiment shifts around artificial intelligence, a lot like what we spoke about last year, Anthony. So if we take the Iran conflict specifically, again going back to the start of the year, markets started with a truly risk-on sentiment. We saw the U.S. underperforming developed and emerging markets. We saw the dollar was range-bound. In the U.S., we saw small caps outperforming large caps. The only kink in that story was the shift in sentiment in AI, where we saw growth underperforming value. Then the Iran conflict hits, and I think we've entered a bumpy, imperfect version of a flight to safety. That would be seen in the US now outperforming global peers and a strong bid behind the dollar. But what I think this reminds us all to do this year, candidly, Anthony, is to come back to the fundamentals. One of those fundamentals is a flight to safety, a market mechanism that had been in doubt for a really long time, and now today is functioning roughly as expected. But the other fundamentals are in terms of core profitability, core quality in the markets. We came into this year with strong consumer activity, strong corporate profitability, and an expectation for relatively constructive policy environments globally. And on our team, we haven't abandoned that constructive outlook.
Right. We've used the word uncertainty for a long time. But this year particularly, even before the Iran conflict, there was a lot of uncertainty around AI, and specifically we were talking about the impact potentially to software, and is AI going to be taking that away from big software companies? So from the beginning of the year, our CIO has put out the theme of the great broadening, which kind of steps a little bit away from just mega cap names to a broader look at sectors, broader look at different regions across the world. What does the market broadening mean for you when you think about the aspect of kind of taking a bigger, broader look at what's available out there? And like you said, that sort of flight to safety kind of feeling.
Sure. Well, what's so fun about market broadening is you can measure it with almost any market indicator you want. A few of our favorites are just basic performance, participation, and also profitability. So if we start with performance, there's actually, I think, a fair bit of room for debate about how narrow the market had even been over the last few years. In 2023, we have to admit, things were very, very narrow. The Magnificent Seven delivered over 100% price performance relative to about 15% for the remaining 493. So almost 8 times the degree of price performance. But in 2024 and 2025, that narrowed to about 4 times and then less than 2 times. So we did see a bit of a broadening actually already permeating into the market. And what's so important about that is almost less that AI's share in that performance declined over time, and more that in the rest of the market, in the 493, they were delivering average annual returns in that 3-year period of about 15%. That is comfortably above the long-term annual average that U.S. equities have been delivering over time, which is roughly 10%. And I think it speaks to the fact that you can continue to have conviction in tech, which our team very much does, while still having constructive expectations for absolute returns across other asset classes and styles.
Yeah, and even if you look even at something like the small and mid-cap space, there's even more opportunity there as they've sort of underperformed those large cap peers. But you're right, those other 493 stocks in the S&P really took a backseat to the Mag 7 in 2023 and 2024 and 2025. And now they're starting to get attention again. So it's interesting to kind of see how it's becoming a little bit more narrow. Like participation itself is widening, but the actual differences between those firms at the top are narrowing a little bit. But let me ask you a question, because I'm reading some of your research, and then we were kind of talking back and forth. You kind of go in with this thesis of broader doesn't always necessarily mean better. Just can you maybe talk about that? Because I don't want to generalize and say, oh, if you just broaden, everything's going to work out just fine. We all know that there's risks no matter where you go when you're investing. Talk about the broader is not necessarily a better concept that you have.
Yeah, absolutely. So it's really the difference between a broader market and a shift in market leadership. That's actually what we've been seeing year to date before the Iran conflict, is we had a shift in market leadership from tech to more risk-on themes. And as we know, those risk-on themes were quite vulnerable to geopolitical disruption, right? So that's why we have such a broad definition of what market breadth can include. And for us, part of that is also profitability. And in that sense, we can maintain conviction in tech here because tech is the profitability hub of U.S. sectors, U.S. styles, equity sizes globally. We've sliced and diced it almost every way we can possibly think to do it.
Exactly.
And tech is the profitability leader. But what is unique, I think, about that story is that doesn't have to come at the cost of the performance of other portions of the market. In 2023 and 2024, for example, we saw a big surge in tech-related earnings growth, and it led that of the rest of the market. We think that that created a halo effect, actually pulling up equities overall, and doing so in a time that wasn't very constructive to capital markets conditions. The Fed had rates at a quite restrictive level for 2023 and for most of 2024, and we saw the loose financial condition effect created by tech as being a powerful counterbalance to
and it was kind of a stabilizing force for some of the rest of the markets in that, with that halo effect that you're referring to.
Exactly. And we can't necessarily completely attribute something like a halo effect to AI in general. Consumption, for example, has been really strong over this period, very, very resilient, as has broad corporate profitability. But generally speaking, the hub and the engine of this has come from the tech side.
And you're generating better returns on equity in some parts of the index when you're looking at a lot of these large cap names in general. And again, that could be part of that halo effect.
Yeah, exactly. And, you can use almost any profitability measure, but generally speaking, it's very difficult to say that valuations in tech read outright expensive because of the incredible profitability that comes along with it. But there are other sectors, as you'll see in the chart, that read quite well on that type of a screen. Staples, for example, reads quite well. So this isn't a tech-specific story. Right,
exactly. Yeah, I think we have to kind of get out of that mindset, as investors and as looking at the markets that AI is driving everything, that there are still, people still need toilet paper. So there's, exactly, when you talk about staples. So let me ask you a question then, Julia. If investors who are watching this, people are watching this, they're thinking about, okay, there is uncertainty still remains, volatility is still something that we're keeping an eye on. It is a little higher than it has been, but not as high as it was in April of last year. What should investors be thinking about going forward, given what we know is happening now and what we don't know will happen in the next couple of weeks or months?
Sure.
Which is, by the way, if we all had a crystal ball.
Right,
but we don't. So what does your research show?
Well, so that's exactly it. No one has the crystal ball. So for us, this year is all about bolstering portfolios against a wider range of possible outcomes, as opposed to piling a portfolio into one potential macro market geopolitical outcome. And to do that, we're leaning on a few themes that honestly have fallen by the wayside quite a bit in the last 15 years. Classic investment disciplines, diversification, and quality. They sound really boring, but when you bake them into recommended asset classes, it becomes quite clear. So for example, In the tech story, we feel comfortable maintaining a market weight neutral allocation there because the quality, measured in profitability, is there. But we also like leaning into a more diversified version of that theme, really speaking to the infrastructure around all of that. That speaks to energy, materials, infrastructure. And as I can already see the gears moving in your head connecting these dots, all of those sectors are also ways to hedge around geopolitical risk. So you can meet the needs of trying to incorporate different themes in a portfolio with the same asset class choices.
Right. I mean, we didn't really even touch on energy today because it is a whole separate conversation, and obviously there are constraints given global oil availability and the price of per barrel. But obviously AI is not stopping anytime soon, so energy is still going to need to be found and consumed and used. So that's another conversation. But I kind of like the idea of we all believe in a diversified portfolio. It's something that we commonly, I think, all can agree on. And obviously, even when you're looking at small and mid cap, if the Fed does cut twice later this year, which we expect at CIO that they will, small mid cap companies are much more levered than large cap companies. So there'll be more attractive rates for them to then build their businesses. So there seems to be opportunity across even different levels of the market, small, mid, and even in the large cap space.
Yeah, absolutely. And look, risks around everything are rising.
Right.
But there's also a really good reason to still have conviction in a constructive scenario, and our team absolutely does. For example, we still think it's possible that the Fed will ease interest rates this year. It's no longer a consensus view, but it's based on the fact that there are still a balance of risks as opposed to trying to get in line with one singular global outcome, right? And so in that sense, keeping a global allocation still balanced, perhaps with an eye toward currency risk management, is also still something that's really compelling to us as well.
Right. I mean, Julia, we could probably sit here and talk for another 20, 30 minutes. Just so much great content. Thank you for coming by and giving us your take on the markets. And we'd love to have you back again soon. Please come back.
I'd love to. Thank you.
Great to see you. Julia Hermann, Global Market Strategist from New York Life Investment Management. And thank you all for joining us. There's a lot more information from our great partners, like Nilam and our own Chief Investment Office, on our website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, UBS Studios has its own Instagram channel at UBS Trending. Lots of content there for you. And as always, if you do have any questions or would like to continue this conversation, please make sure that you are doing so with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody. Thanks.